Welcome back to the Daily Crypto Deep Dive. Today's episode is about something uncomfortable but absolutely critical to understand if you want to survive and eventually benefit from this market. Most investors don't fail because they were wrong about crypto. They fail because they quit one cycle too early. Not in a panic, not during the crash, not when headlines are screaming. They quit when they're tired, when they're bored, when the market feels pointless, when nothing seems to work, and when the emotional energy is gone. If you've ever found yourself thinking, I'll just step back for a while, or I'll come back when things look better, or I'm done watching this every day, then you're not weak, you're human. Quick note before we get into it. Today's episode is sponsored by Kraken. Kraken is one of the longest-running crypto platforms in the industry, known for security, deep liquidity, and transparency. If you're looking for a reliable way to access the market, you'll find a link to Kraken in the description. Getting back to it, here's the part most people misunderstand about market cycles. People don't usually quit during crashes. Crashes are loud, emotional, dramatic. They give you adrenaline. But people don't quit during chaos. They quit during silence. They quit when prices drift sideways for months, when every rally fails, when good news does nothing, when bad news barely registers, and when checking prices feels like a chore rather than a thrill. That's when people leave. If you go back to late 2018, after Bitcoin had already fallen from nearly $20,000 to around $3,000, something important stands out. The crash was over. The damage was done. And yet participation collapsed. Reddit posts from that period weren't full of panic. They were full of exhaustion. People talked about losing interest, wanting their lives back, and feeling stupid for caring so much about something that seemed to go nowhere. One retail investor later admitted he sold most of his holdings not because he needed the money, but because he couldn't emotionally justify paying attention anymore. Years later, he went back and looked at what he sold. Almost every asset went on to multiply in value during the next cycle. His conclusion wasn't anger. It was regret. "I sold because I was tired," he said, "and I regret it every single day." That pattern repeats every cycle. People don't rage quit crypto. They rationally quit crypto. They tell themselves stories that sound sensible. I'll re-enter later. I'll wait for confirmation. I'll invest when things are clearer. But markets don't reward clarity. They reward endurance. And this isn't just a retail phenomenon. In early 2018, after the ICO bubble collapsed, crypto hedge funds began shutting down in waves. Not at the top, not during the crash, but after it. When volatility dried up, when investor interest evaporated, when fundraising became impossible. Funds closed, capital was returned, teams moved on. Many sold near the bottom. By the time Bitcoin recovered into 5 figures in 2019, they were gone. By the time the next bull market arrived, they weren't even watching. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Crypto has simply compressed that lesson into shorter, more violent cycles. The same thing happened again in 2022. After Terra, after Celsius, after Three Arrows, after FTX. By late 2022, the fear had already peaked. Bitcoin sat around $16,000. Headlines declared crypto dead. Confidence was shattered. And again, people didn't panic. They checked out. Crypto YouTube views collapsed. Twitter engagement dried up. Podcasts stopped publishing. Influencers disappeared. Regular investors said things like, "I'm done with this," or "I'll just sit in stablecoins," or "I don't want to hear about crypto anymore." Even institutions weren't immune. Tesla sold roughly 75% of its Bitcoin holdings in mid-2022. Not at the top, not during peak fear, but during the exhaustion phase. At the time, it sounded sensible. In hindsight, those coins would have been worth billions more just a couple of years later. That wasn't stupidity. It was fatigue. Ray Dalio has said many times that the hardest part of investing isn't intelligence. It's emotional control during long, boring, painful periods. Crypto magnifies that weakness. Another moment came in December 2022, when Jim Cramer publicly said he had sold all his crypto and wouldn't touch it again. That moment mattered not because of who said it, but because of when he said it. It captured the emotional low point of the cycle almost perfectly. Within months, the market began recovering. Here's the uncomfortable part. The people who quit aren't uninformed or reckless. They're often the most engaged participants. They stayed through the crash, read everything, watched every chart, followed every story. And that constant engagement is exactly what burns them out. Smart investors don't usually get wiped out. They get worn down. They overthink, seek certainty, wait for perfect conditions. Meanwhile, many of the people who benefit most from cycles aren't smarter. They're just still there. Sometimes because they made a long-term decision and stopped watching. Sometimes because they forgot about their wallet. Sometimes because they didn't have the emotional bandwidth to keep reacting. Peter Lynch once said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." Crypto is brutal in this regard. The most dangerous phase isn't the crash, it's the boredom. Because boredom convinces you that nothing will ever change. Pause for a moment and be honest with yourself. Do you check prices less, not because you're disciplined, but because you're drained? Do you avoid talking about crypto with friends? Do you feel embarrassed mentioning it? Do you tell yourself you'll come back later without a plan? Those aren't signs of wisdom. They're signs of exhaustion. And markets are designed to exploit exhaustion. The real transfer of wealth doesn't happen at euphoric tops. It happens quietly, when people hand over assets simply because they're tired of caring. Before we continue, quick pause for today's mid-episode sponsor. If you're holding crypto long-term, custody matters. A Ledger hardware wallet allows you to store your assets offline, reducing reliance on exchanges and third-party risk. It's one of the simplest ways to improve your security posture without complicating your setup. If you want to support the show and take control of your assets, you'll find the Ledger link in the description. Now back to the cycle. One of the cruelest aspects of markets is that they never ring a bell at the bottom. There's no announcement, no green light, no moment that feels safe. When markets turn, it feels uncomfortable. It feels wrong. Because sentiment is still negative, narratives are still pessimistic, confidence is still low. If things felt good, prices would already be higher. That's why so many people miss the first 30, 40, even 60% of a move. And once they miss it, re-entry becomes psychologically difficult. They anchor to old prices, wait for pullbacks, tell themselves they'll buy the dip, and the dip never comes. Years later they say, "I knew crypto would come back." But knowing isn't the same as staying. Howard Marks put it best. You can't predict, but you can prepare. Most people prepare for crashes. Almost nobody prepares for boredom. This is also why influencer content becomes most dangerous near bottoms. Bearish content performs best when sentiment is lowest. Doom validates exhaustion. Negativity spreads fastest when people want permission to quit. Influencers are human too. They get tired, lose motivation, stop posting, creating a feedback loop of less content, less interest, and less belief. Meanwhile, infrastructure improves quietly, regulation becomes clearer, capital positions patiently, and builders keep building. But because there's no excitement, nobody notices. The winners behave differently, not because they're fearless, but because they accept uncertainty. They don't expect confidence, clarity, or excitement. They adjust expectations instead of abandoning positions. They understand that cycles reward survival, not perfection. And survival doesn't mean never selling. It means not selling because you're emotionally exhausted. It means making decisions when you're calm, not drained. Here's how you know you're about to quit a cycle too early. You stop learning not because you've mastered the space, but because you're burned out. You seek reassurance constantly, but nothing reassures you. You feel numb instead of afraid. That numbness is dangerous because it feels rational. And here's the final truth. Markets don't end when you're done with them. They start working against you. Every cycle is designed to push participants out before rewards are distributed. That's not manipulation. That's human behavior. If you remember nothing else from this episode, remember this. You don't need to be early. You don't need to be perfect. You don't need to time the bottom. You just need to still be there. Because the biggest difference between people who benefit from cycles and people who talk about cycles isn't intelligence, it's endurance. Thanks for listening to the Daily Crypto Deep Dive. If this episode resonated, share it with someone who feels like they're done with crypto right now. And if you want to support the show, check out Kraken and Ledger in the description. And as always, we'll see you at the top.